If you looked at the headlines recently with, wars breaking out, inflation surging, basically just massive geopolitical chaos everywhere.
Yeah, total chaos.
Right. And if you check the old financial rule book, you would probably bet your life savings that gold was just skyrocketing.
Yeah.
I mean, you see a crisis, you buy gold.
That's the classic move, yeah.
Exactly. It's supposed to be the ultimate financial bunker. You lock your wealth in there, and you just wait out the storm. But if you actually look at the charts right now, that ultimate financial bunker seems to have a pretty massive leak.
It really does.
Global tensions are sky high, and yet gold has really struggled. At times, it's even actively declined, which is just wild.
It's basically the absolute definition of a broken market assumption. Like, when the real-world data completely contradicts decades of conventional wisdom, it leaves a lot of people who pay attention to this stuff just completely scratching their heads.
Which is exactly why we are jumping into this today.
Yeah.
Our mission for this deep dive is to figure out why the ultimate safe haven is acting, well, completely out of character.
Yeah, we need to look under the hood.
Right, we're going to pull back the curtain on the deep structural forces shifting underneath the global economy. That way, you can view the markets the way an actual macro strategist does.
Okay.
So, let's just start with the big question. Is gold just fundamentally broken as an asset?
No, not at all. Gold itself hasn't failed, and, the metal hasn't changed its properties. It's still gold.
Okay.
What has happened is that the macro environment, like the entire financial ecosystem in which gold operates, has undergone this massive structural shift.
Right.
So the variables that used to reliably push gold higher during a crisis, they're simply no longer the dominant forces in the room.
Okay, so to understand why it isn't working now, we should probably establish why it used to work so reliably in the first place.
Yeah, let's go back a bit.
Think back to, say, the financial crisis of 2008, or even the spring of 2020 when the pandemic first hit. The world panicked, markets crashed, and central banks basically immediately fired up the money printers.
Right. They rushed in with very aggressive easing. They pushed interest rates all the way down to zero and just injected massive, unprecedented amounts of liquidity into the financial system.
Just to stimulate growth and stop a total economic collapse.
Exactly. Now, if you are holding gold, that specific central bank reaction is it's essentially a perfect storm in your favor. It creates three key drivers all at once.
Which are?
You get falling real yields, a weakening U.S. dollar, and rapidly expanding liquidity.
Okay, so holding gold used to be like opening an umbrella. It only made sense because you could reliably count on central banks to make it rain liquidity the exact second a crisis hit.
That's a great way to put it. You open the gold umbrella because the liquidity rain was guaranteed. And in that environment, the opportunity cost of holding gold was basically zero.
Because opportunity cost is just the money you're missing out on by not having your cash invested somewhere else, right?
Right. If your savings accounts and your government bonds are paying you literally 0%, you don't lose anything by holding a physical bar of gold.
Makes sense.
Add in the widespread fear that central banks were debasing the currency by printing so much money, and, well, that risk-off panic buying sent gold prices through the roof.
But the central banks have completely put away the rain machines now.
Yeah.
We have moved out of that liquidity-driven regime entirely.
We have. We've transitioned into an inflation-driven regime. Central banks are no longer focused on stimulating growth at all costs.
Right, the vibe has shifted.
Totally shifted. Their primary mandate right now is fighting inflation. And they'll do that even if that fight actively slows down the economy or causes unemployment to tick up or just creates pain in the stock market.
So this has created the whole higher for longer interest rate environment we keep hearing about.
Exactly. Interest rates remain elevated, and that abundant cash we used to see just sloshing around the system is tightly constrained now.
So if money is no longer free and abundant, holding an asset like gold that doesn't actually pay you a dividend, well, that suddenly becomes a lot more expensive to justify.
Yeah, we are dealing with an entirely different set of physics in the market now, which really brings us to the gravitational pull of the current financial universe.
Which is real yields.
Yes, real yields are the single most important variable dictating gold's behavior today.
Let's define that for anyone listening outside the traditional finance bubble, because we hear the word yields constantly. But a real yield is a very specific mechanism.
Right. A real yield is simply the return an investor makes after adjusting for inflation.
Okay.
It's the actual tangible growth of your purchasing power. So, for example, if a U.S. government bond pays you 5% a year, that is your nominal yield.
The sticker price, basically,
Right, exactly. But if inflation is actively eating away at the value of your money at a rate of 3% a year, your real yield is only 2%.
because you subtract the inflation.
Yep. You are genuinely growing your wealth by 2% above the rate of inflation.
And because a bar of gold just sits in a vault, it doesn't clip a coupon, it doesn't generate quarterly earnings, it doesn't pay any yield at all, its appeal is entirely dependent on what investors could be making somewhere else.
You nailed it. The attractiveness of gold depends heavily on the alternatives. When real yields rise, the opportunity cost of holding a non-yielding asset like gold just skyrockets.
Right.
Institutional investors look at the landscape and realize they can earn a guaranteed inflation-beating return of 2% just by holding government debt. So naturally, capital flows away from gold and into those interest-bearing instruments.
Okay, let me push back on this a bit because there feels like a massive contradiction here.
Okay, let's hear it.
If we are in an inflation-driven regime and inflation is the primary economic threat, well, shouldn't gold be the ultimate hedge?
Ah.
I mean, historically, people buy gold specifically to protect themselves against inflation. So why is it struggling right now if inflation is the exact thing everyone is worried about?
That is the exact trap a lot of casual investors fall into. It's super common. But inflation alone does not guarantee higher gold prices.
Wait, really?
Really, it is not the inflation itself that dictates gold's movement. It is the central bank's response to that inflation.
Oh, interesting. So gold performs beautifully when inflation runs hot, but central banks just sit on their hands and do nothing about it.
Precisely. If central banks keep interest rates at zero while inflation climbs to 4 or 5%, your real yields go deeply negative. You are actively losing purchasing power by holding cash or bonds.
And in that scenario, gold soars because it's a hard asset, a reliable store of value.
Yes. However, when inflation triggers aggressive, sustained rate hikes like we saw throughout 2022 and 2023, that dynamic flips entirely.
Because they're actively fighting it.
Right. The central bank aggressively raises nominal yields. Meanwhile, inflation expectations start to stabilize or even drop because the broader market actually believes the central bank will successfully do its job and crush the inflation.
Oh, I see. So the math changes completely. The nominal yield goes up, the inflation subtraction stays steady or even shrinks, and suddenly that real yield number gets much bigger.
Exactly. That combination pushes real yields significantly higher, which creates this immense, sustained downward pressure on gold.
Wow.
And that downward pressure from high real yields is so heavy that even severe geopolitical risk, which is the traditional panic buying trigger, it just isn't enough to offset it.
So the gravity of the interest rates is quite literally stronger than the fear of global conflict.
Yeah, the structural forces working against gold are simply mathematically stronger than the emotional safe haven demand trying to support it.
That's fascinating.
Yeah.
But, gold isn't just losing its appeal in a vacuum, though. I mean, it is actively getting beaten up by a direct competitor in the safe haven space.
Oh, definitely.
It's directly competing against the U.S. dollar.
Right, and gold and the US dollar traditionally move in opposite directions. You have to remember, gold is priced in dollars globally.
So when the dollar gets stronger, gold automatically becomes more expensive for anyone holding a different currency.
Exactly. If you are an investor in Japan or Europe and the dollar surges, buying an ounce of gold suddenly requires far more yen or euros. That entirely crushes global demand for the metal.
And the dollar is currently being supercharged by two massive forces simultaneously, right?
It is. First, you still have the traditional safe haven demand. When the global outlook gets scary, institutional investors want maximum liquidity, and honestly, nothing on earth is more liquid than the US dollar.
Sure.
But second, and far more importantly right now, you have those higher interest rates. The US central bank has been offering higher rates compared to a lot of other major global economies.
So in a crisis, the dollar is currently offering investors both a bunker for safety and a paycheck through high yield, whereas gold is only offering the bunker.
Exactly. Why would a massive institutional fund manager pay hefty fees to store physical gold in a vault when they can just hold US dollars, get the exact same sleep at night safety, and get paid a 4 or 5% yield for the privilege?
Yeah, I mean, you take the bunker with the paycheck every single time.
Every time.
Wait, so if everyone buys dollars for safety and yield, the dollar gets stronger. But a strong dollar makes everything priced in dollars like gold weigh more expensive globally, which crushes demand even more. That sounds like a doom loop.
It is absolutely a vicious feedback loop. When global capital floods into the US dollar, the dollar strengthens, and that actively tightens global financial conditions.
Because it makes it harder for everyone else.
Right. It makes it harder for emerging markets to service their dollar-denominated debt. They often have to sell off their own local currencies or reserves just to buy the expensive dollars they need to pay those debts.
Oh, wow. Yeah.
It makes global trade more expensive. It essentially acts like a giant brake pedal on the entire global economy.
And tighter financial conditions weigh heavily on all commodities across the board. So the dollar's strength is actively suppressing the entire commodity complex that gold lives in. Okay, so we've been talking about this in theory. Central banks, real yields, the dollar doom loop. But let's look at the actual trading floor. When money stops being free, how do the big institutional players actually physically change their behavior?
That really comes down to market plumbing. We discussed how central banks used to flood the system with liquidity. Now they are engaged in quantitative tightening, or QT.
How does that actually work mechanically? People always hear the phrase shrinking the balance sheet, but what is actually happening to the cash?
Well, during the easy money days, the central bank bought government bonds from commercial banks. They handed those banks fresh cash, which the banks then lent out into the economy.
That was the liquidity rainstorm we talked about.
Exactly. Now, under QT, they are doing the exact reverse. The central bank holds a bond until it matures. The government pays the central bank back the principal, and the central bank simply deletes those digital zeros.
Wait, they just deleted? The money isn't reinvested?
Nope, it just ceases to exist. They are systematically draining the cash right out of the financial ecosystem.
Man, when you drain billions of dollars of abundant liquidity out of the system like that, speculative flows must just dry up immediately.
They do. When money was virtually free, investors could afford to just throw capital at non-yielding assets, basically hoping for price appreciation. They had the excess cash to speculate on gold.
Right. Why not take a flyer on it?
Exactly. But in tighter financial conditions, your margin for error disappears entirely. Investors become hyper-selective.
So institutional investors actively rotate their capital out of speculative or non-yielding positions and move it into bonds, cash equivalents, and assets that generate a clear, reliable income.
Yes. And we really cannot ignore the role of the machines in all of this.
The algorithms.
Yeah. The market structure today is heavily, heavily dominated by algorithmic trading. The vast majority of daily trading volume is driven by systematic strategies.
So just algorithms making thousands of decisions a second based on pre-programmed mathematical inputs. But how does an algorithm actually look at an interest rate? Because, it certainly isn't reading the morning paper over coffee to gauge geopolitical anxiety.
No, they don't care about the news. Algorithms are fed massive storms of data via APIs directly from the bond and currency markets.
Okay.
They are programmed to respond to specific numerical triggers. For instance, an algorithm doesn't care that a conflict broke out overseas. It has no concept of fear, but it is programmed to rigorously track the yield on a 10-year treasury bond.
So if that bond yield rises by just a tiny bit.
Yeah, even just a few basis points. And a basis point is just 1/100%.
Right.
If it ticks up, the algorithm's code tells it to instantly execute a massive sell order on gold ETFs and buy the US dollar.
And that happens in what, milliseconds?
Milliseconds. It is a completely automated response that strips human emotion, fear, and traditional panic entirely out of the equation.
That is wild. Gold is literally being traded less as a crisis hedge and more as just another macro asset tied to interest rates. The human fear factor is actively being priced out by code that literally only cares about yield.
That's exactly what's happening. The algorithmic trading just completely reinforces the structural shift we've been discussing.
Right.
The machines ensure that gold's daily price is now far more sensitive to a minor 25 basis point shift in interest rates than it is to a major risk-off trigger in the geopolitical news cycle.
Viewing it through this lens completely changes the game. If we synthesize all this data, the real yields, the strong dollar, the quantitative tightening, and the algorithmic trading, how do you, as the listener, actually use this information the next time you look at your portfolio or read some terrifying news headline?
The most effective way to understand macro investing is through the framework of regimes.
Regimes.
Yeah, markets operate in distinct environments, and you really have to identify which regime you are currently living in.
So what does a good regime for gold look like?
A gold-positive regime is characterized by 4 specific conditions. You have falling real yields, a weakening U.S. dollar, expanding central bank liquidity, and dovish central banks.
Dovish meaning they are accommodating, prioritizing economic growth, and basically eager to cut interest rates.
Yes, exactly. If you see those four things, falling yields, weak dollar, high liquidity, dovish policy, gold will likely soar.
That is the classic environment where the safe haven narrative works perfectly.
Right. Now, look at the exact opposite. A gold negative regime is defined by rising real yields, a strong U.S. dollar, tight liquidity, and hawkish central banks.
Hawkish meaning they are aggressive, prioritizing the fight against inflation and perfectly willing to keep interest rates high to win that fight.
You got it. And if you look at the data today, we are firmly, deeply entrenched in a gold negative regime.
Yeah, we check every single one of those boxes right now.
We do, and that framework completely demystifies the broken assumption we started with. It perfectly explains the apparent contradiction of gold falling during periods of heightened global risk. Gold hasn't forgotten how to be a safe haven.
It is just operating in a structural environment that is mathematically designed to suppress it.
Exactly.
This means the old narrative of always buy gold during a crisis isn't just tired. It's actively misleading advice right now.
It really is.
Gold is not a default hedge that magically protects you just because the news cycle is bad. It is a conditional hedge.
It is highly conditional. Its performance depends entirely on the broader macro structure, the yields, the dollar, the liquidity, rather than isolated news events.
So if you understand the structural forces underneath the market, you actually understand the asset's true behavior.
Exactly. You have to look at the foundation, not just the weather.
We started this deep dive by talking about the financial bunker.
Yeah.
And, we've realized that the bunker isn't broken. It's just that the storm we are facing right now isn't the kind of storm the bunker was built to withstand.
Right.
We're dealing with an interest rate hurricane, not a liquidity rainstorm.
And in an interest rate hurricane, you need a very different kind of financial shelter.
Which leaves us with a pretty massive question to walk away with. Think about this. If gold, literally the oldest, most historically reliable safe haven in human history, has fundamentally changed its behavior based on interest rate regimes rather than global fear, what other safe investments in your portfolio might actually just be disguised bets on low interest rates?
Yeah.
If the ultimate bunker isn't what we thought it was, it might be time to inspect the foundations of everything else.